So what does a homeowner's policy actually cover? Well, today we're going to dive in and actually go over the coverages of a house policy and a couple of other little pieces that you should know about a home policy. My name's Mark with Think Insurance. I just want to put a quick disclosure out there. I do recommend you always talk to your agent to get some exact finite details. I don't really offer quotes on homes, although if you really want to work with a company that I work with, they work with 17 different companies. They're across 21 states. The link below, it'll take you to my page, but it is going to ask you only for car information. What they will do when they call you, because they usually call out to verify some information, is they'll actually ask your home information as well, because everybody knows that home and auto together is the best way to save the most money. So let's dive right into the home coverages. The first part is coverage A. There's nothing to it. It's A, B, C, D, E, and F. So you've got A, which is your dwelling. If you own a mobile home, it's your mobile home. If you own a stick-built house, it's that house. So anything that you insure, that's a dwelling A. That is going to be what's called replacement cost. Most companies won't let you go below 100% of the value of the home. And it's not the value that you're thinking of. It's not what you would sell your house for. It's how much you're going to have to pay somebody to rebuild it if the whole thing got demolished. That is typically going to be that higher limit. Let's just use in this example, a standard $250,000 house. I might only be able to sell it for $200,000, but it might be worth $250,000 to rebuild. The second piece is coverage B. Then coverage B is your other structures. So that's basically anything that's not directly attached to the house. Your deck is bolted onto the house, so that's not part of that. If you have a pool attached to that, it's not typically part of the house unless there's a concrete patio that goes to the pool. In some of those cases, that coverage B or even coverage A will cover that pool. But if it's not directly connected or part of the home, then something like that is going to be a separate structure or other structure. Fence, shed, anything that's a patio, pergola, anything that you have separate from the house, that's coverage B. You're typically going to have a little bit of extra coverage for that. That way, if something there happens, you're typically going to have the coverage B at 10%. So then if we go into coverage C, that's going to cover your personal property, your TV, your couch, anything that you own that is in the home that has some sort of value to it. It doesn't cover usually media. So if you have some special tax software on your computer and the computer gets fried, they're not necessarily going to cover the actual pieces of that. There are other coverages you have to go after to get that stuff. That's more of a business thing than it is in your personal policy. So you've got all the main stuff. But the biggest thing you want to make sure that you have in that coverage C is that you have full replacement cost. That essentially means that you're going to get today's market value for that item. If you have a 10-year-old couch, it's only worth $100 at a garage sale. I'm not going to be able to replace that couch for that amount. So if I have the full replacement cost, it's going to cover that full value. Maybe it's a $1,000 couch or a $1,500 couch. Now I'm going to get that amount if that's the value of that replacement in the store. That leads us into coverage D. D is called loss of use, which is living expenses. They also call it other living expenses, usually in hyphenated. And what that does is that pays for anything that you can't do or use at the house. What I mean by that is, let's say the kitchen catches fire. It's going to take 3 months to rebuild the kitchen. That means I'm probably going to move out of the house and rent another house. Well, I don't have time to go to work and go to the house and mow the lawn and then come back and mow the other lawn. So I'm going to pay someone to mow the lawn. I'm probably going to pay because maybe the house that I'm at doesn't have a great kitchen. I'm probably going to go to fast food for the next week and a half while I get everything set up. I'm going to have all these extra expenses like gas going further than I normally do, checking on the house, making sure things are secure, all of that. So that's additional living expenses. You'll typically see that close to 30% of the policy, so there's usually enough coverage in there to take care of you. Coverage E and F are kind of a combined piece. They are separate. You've got coverage E, which is your liability limits, and you choose these coverages. So you either do 100,000, 300,000, 500,000, all the way up to $1 million or more. It really usually caps out at $1 million. What that is that's for anything that you're liable for. The roof caves in on somebody, if someone slips on some ice on the steps that you didn't get to, but you normally do, if there's some sort of thing that you're not negligent on. Now, if you ignore the steps and they're always slippery and the mailman comes and slips on them, they're probably going to deny that claim because now it's going to show that you were negligent. You didn't take care of that property. Same thing goes for sidewalks. So all of that stuff is they're going to sue you for. Well, what they've done is they've added an additional coverage which is going to cover what's called medical payments. And that's coverage F. So what that's going to do is that's kind of what they call hush money. So it's basically, it's kind of a bad term to say because we tell agents never to say that. It's not really hush money. It's kind of a dirty term. But what that does is that allows them to take $1,000 or $5,000. You choose either 1,000, 3,000, 5,000. The two most common are 1 and 5. So let's say I had 5,000 med pay and you slipped on my steps, you broke your arm. It's $4,000 for that cast. They're going to give you that $4,000, even the $5,000 if you can prove that you need it, just to get you gone. They're going to say, okay, you're not going to sue us. Great. Here's $5,000. Please sign this waiver. Have a great day. Now, that is why they call it hush money, because it's essentially easy to get that money. They're going to send it out as quick as possible to try to get somebody not to go after that liability. Because if you have that $500,000 worth of liability, then that's going to hurt them a lot worse than paying $5,000. There you have it. Those are the main pieces of an insurance policy for home. The additional parts that I didn't go over was the major piece that most people miss. It's called water backup and sewer and pump. So if you guys don't know what that coverage is, I'm actually going to link that right here. So go ahead and watch that video. Also, there is a couple things I wanted to touch base on. So if you're a renter, you're going to see something not as an HO3. So an HO3 is your typical home policy. It's a stick-built house. Then you've got an HO4, which is a renter's. And then you've got an HO5, which is also home, but it's more specialty. We're not going to get into that. And then we've got an HO6, which is a condo. So if you look at the top of your declarations page, make sure we're talking about an HO3. There's also additional things that you do need to know about as far as like jewelry goes or furs and guns and all that stuff. I'm actually going to make another video, so if you guys haven't subscribed already, make sure you subscribe so when that goes live, turn on that bell icon and you'll get first to be notified. I'm Mark with Think Insurance. I will see you in the next one.